Josh, why the Fed raising rates and the government printing money would actually be incredibly bullish for the markets. Tell me why.
Let's take an extreme version of this situation. Let's say the Fed raises rates 100% from what they're currently doing, but at the same time, the government gives everybody $1 million. What would happen in that situation? Well, everyone thinks that, well, if the Fed's raising rates, that's going to be deflationary because the cost to borrow money is going up, therefore less lending, therefore less dollars in the actual economy. But if the government backstops that and just leaps forward, they could get all the money in the system without having to rely on any lending. Therefore, we could see massive amounts of inflation, both in goods and services and in asset prices. But let's take this to a more realistic conclusion. What just happened? The government just came out with this new massive inflation reduction bill, which they're trying to give out hundreds of billions of dollars into the economy to fight inflation. But let's say the Fed continues to raise rates by 75 basis points, 100 basis points, but these types of spending bills start to get passed. What's going to happen to consumer price inflation and to CPI? If we take that same theory, where if the government is giving these non-bank entities, me, you, and the Joe and Janes throughout the public, then everyone's going to have more money to both spend on asset prices and goods and services. So we could see a bid in stocks, in CPI inflation, but at the same time, we could have the Fed raising rates even higher. That's going to cause massive mayhem across the credit market, but it won't matter because the dollars are already in the system.
By virtue of the government basically force spending the money into the bank accounts of you and I, right?
Correct.
Yeah. Josh, I think it's also interesting just to circle back and you think back what happened during COVID or whatever, right? Think back to the PPP programs and the various stimulus checks that were issued. One of the things that I think we saw back there is people say, well, we didn't see that much inflation. And I would actually argue, as many other people have argued too, we did see inflation, but we saw inflation in asset prices because when people got these, what did they do? They just dumped it into the market. So in a strange way, the prices went up of the assets. So, the units of currency on your balance sheet, on my balance sheet, on everyone else's balance sheet, were searching for goods and services to buy. It just so happened that the goods and services that were bought were stocks. And when people who buy stocks and those stocks go up, or those ETFs or whatever go up, it makes them feel very good. So in a strange way, it was inflation in asset prices, but it was inflation in asset prices that made people happy. So it was a very weird thing versus like inflation in asset prices. You go to the store and all of a sudden, your steak and deodorant or laundry, quadruple in price. So it's an interesting phenomenon there.
This is completely game theory right now because we have absolutely no clue what's going to happen because there's so many cross currents at play. Let's take an example of a tub of water, and let's say the Fed raising rates is going to lower that tub of water because they're sucking the liquidity out of it. But at the same time, the government comes in with these spending bills and they actually get them passed. Then it's like them dumping another bucket of water on top of that tub. But there's so many cross currents. Is the Fed raising rates fast enough to drain that tub, or is the government dumping water going to increase that tub even further? And that tub is inflation and dollars being circulated in the economy, and that's going to correlate if asset prices start to go up at the same time the Fed is raising rates. It is entirely possible, and in fact, I think the most probable outcome if they do pass these stimulus checks. I personally don't think they'll be able to get too many of these things passed just because the government's main goal is that they are saying they're going to tame inflation. And what are they doing right now? They are coming out with the Inflation Reduction Act. That is going to give everybody more money, which is going to help them with, one, getting reelected, two, causing more inflation, and three, doing absolutely nothing that they said it was going to do.
Yep. And just going back to your bucket analogy too, the way you can think about that is, there might be a trickle in the bottom of the tub leaking water out, but that is nothing compared to the fire hose that's spewing water into the top. So good mental analogy there.
Yeah, predominantly in the past, bank lending was the majority of the dollars being created, but we have seen banks not lend into the same degree ever since 2008. And because of this, the government is starting to step in ever since the COVID era. And if they continue to pass these stimulus packages with like the one they just announced and the Senate just passed the other day, then we could still see consumer price and asset price inflation rising at the same time interest rates are going up. This is just proving or a counterpoint to the misconception where every single talking head on the mainstream media says if the Fed is raising rates, deflation is coming 100% certainty and all assets are going to come down. It does not always work like that.
Yeah, what I would say is they are correct if nothing else happens. But if something else happens, then they are incorrect. That's a problem with experts. As Friedman says, the complexity of their models exclude the complexity of the whole. So
Yeah, even just to disprove that thesis again, let's say the Fed starts to raise rates and it's working successfully. The government doesn't issue any new currency, but banks just start lending like absolute crazy amounts. Every single person that wants a loan, they give a loan, and demand for loans increase. Then the exact same thing would happen. New dollars would be in the system. Nothing would be affected because interest rates rising, the banks make more money. People don't care. They're still taking out the loan. And if the money is there, then and the money is circulating, then that's all you really need to have inflation continuing to skyrocket in both asset and CPI. And this is by no means my base case. It is strictly a counter view to a lot of current theses.
yeah, a thought experiment.